Moving on now to learning objective C, which is to apply AASB 3 to a business combination including goodwill, bargain purchases and provisional amounts. So this is the more practical side of the topic now, and we're going to look at this example here. So on the 1st of January 2012, A Limited acquired all the assets and liabilities of B Limited. And details of the consideration are as follows. There's a cash consideration of $400,000 to be paid, half on the 1st of January 2012 and the balance due 1st of January 2013, so 1 year later. And there's an incremental borrowing rate of 10% here. So for this example we will include we'll have to discount it. The next point there says there's 100,000 shares in A that were issued, and the share price as at the date of acquisition was $1.50 per share, and this price represents a 6-month high, and costs of issuing these shares was $1,000. So that's not going to be considered part of the acquisition related expenses, is it? Because we talked about that a couple slides ago. It's going to be considered a reduction of share capital. Third point, due to doubts as to whether the share price would remain at or above $1.50, A agreed to supply cash to the value of any decrease in the share price below $1.50, and this guarantee was valid for a period of 3 months to 31st March 2012. And they believed that there was a 75% chance that the share price would remain at or above $1.50 until that time, and a 25% that it would fall below $1.40. And then the next point says there was a supply of a patent to B, and the fair value of the patent is $60,000, and because it was internally generated, it didn't meet the recognition criteria. It couldn't be recognized. You can't recognize internally generated assets, which you learnt about in ACC322. However, as part of the combination it can be. So A is giving B a patent to B for $60,000. Just clearing that up. That's what's happening in that second last point there. And then the last point here, it says that legal fees and associated costs with the acquisition totaled $5,000. So that one would be considered an acquisition related expense. So let's have a look at this a bit more on the next slide now and calculate the answer. So this is the calculation of the consideration transferred. And looking at cash first up, we had $200,000 that was due as at date of acquisition, so that's $200,000, no discounting involved there. However, the other half, the other $200,000 was paid a year later, so that will need to be discounted by the incremental borrowing rate, which was 10%. So 1 divided by 1.1 representing that 10% equals 0.9091, or here they've gone to a few more decimal places. Next we've got the shares at their fair value, $1.50. So 100,000 times $1.50 is 150,000. We've also got this guarantee to consider. So that's based on the probability of the share falling below $1.50. There was a 25% chance of that happening, and if it did, they thought it would reduce to $1.40. So we're including that as a consideration as well. And there's also that patent which we need to recognize as well. So the total cost of the acquisition, therefore adding up all those figures, is $594,318. Goodwill provides future economic benefits from assets that could not be individually identified or separately recognized in the combination. And when this residual amount results in goodwill, so when you compare the the fair value of identifiable net assets against the consideration transferred and the residual results in goodwill, that amount needs to be recognised as an asset and measured at its cost as at the date of acquisition. So it's considered this residual, and as such it's affected by the way consideration is measured and how and what is recognised in the fair value of identifiable net assets. So it says in this last point here that goodwill is an unidentifiable asset which is incapable of being individually identified and separately recognised. So what that means is there are say intangible assets that get identified from the business combination that weren't previously recognised, such as brand names or some masthead, something internally generated that's an intangible that wasn't previously recognised, that gets separated, and whatever's left over is considered goodwill. And if we didn't separate them, the goodwill amount would increase, but it wouldn't be a true reflection of all the assets that are within the entity acquired. So now continuing on from the example we looked at on slide 22 and 23, where A Limited acquired B Limited, the assets and liabilities acquired are listed here, and we've got the carrying amount on the left hand side column and the fair value on the right hand side. So for the assets, plant and equipment, land, inventory, accounts receivable, we've got different values between the carrying amount and fair value, but for the accounts payable and the bank overdraft, the liabilities, we have the same amount between carrying and fair value, which we would expect. It also says down the bottom here that B is currently being sued by a previous customer, and the expected damages are $50,000. However, the lawyers estimate there's a 20% chance of losing the case. That would be considered a contingent liability, so it wouldn't be included in the accounts prior to acquisition for the acquiree B. So within the business combination, we'd need to recognise that amount. So we've been required to firstly calculate the fair value of identifiable net assets acquired and determine the goodwill on acquisition, and then to prepare the journal entries in the books of A Limited to account for the acquisition. So to answer A firstly, we start with the fair value of the recorded net assets, which is $580,000, and you can see that on the previous slide, which is the total amount of the fair value. We're not using the carrying amount. That's the first thing you've got to watch out for, making sure you use the fair value of assets, not the carrying amount. Next, we've got that contingent liability consider. That's a reduction of the net assets value, and it was $50,000 the expected cost, but a 20% chance of that happening. So 50,000 times 20% equals $10,000. So taking that off, we're left with a fair value of identifiable net assets of $570,000. And now we compare that amount against the cost of the acquisition, so the consideration, and that was calculated previously on slide 23, and after deducting that, we're left with a goodwill on acquisition of $24,318. Now to answer part B of the required and prepare the journal entries in the books of A Limited to account for the acquisition. So you'll need to refer to slide 22 as well as slide 25 in answering this, because not only do we have to consider what we're acquiring, but also what we've given up as consideration. So firstly here we've got plant and equipment, land, inventory and accounts receivable, all as at their fair value. So they're debits, they've been acquired, they're going into the into A's accounts. Then we've got the goodwill figure we calculated on the previous slide of $24,318. I usually, when I'm answering a question like this, I would leave the goodwill to last, and that's because I use the goodwill figure as my balancing amount. So I'll enter in all my debits, enter my credits in, and then I'll figure out what the difference between the two are, and I sort of use it as a verification technique to make sure that the difference between the two equals $24,318, which was what I calculated in my acquisition analysis on the slide 26, just to make sure I've done everything right. So on the credit side, we've got $35,000 for accounts payable and bank overdraft $55,000. That's fair value equals the carrying amount. That's fine. We're also recording that provision for damages, that contingent liability there, and then we had to pay $200,000 cash up front, and also we'll record this now even though we're not actually paying it, that deferred consideration payable, which was discounted by the 10%, so that's $181,818. We also had to issue some shares as part of the consideration at $1.50 per share, so that's accounted for there. And then the provision for loss in value of shares, that was in case they did drop to $1.40, we're just provisioning for that. And we also had to provide a patent as consideration, so that's why that's a credit to $60,000 gain, because we still have to recognize that there's a sale there, even though we're not crediting a patent account because there is none that existed. We still need to record a gain to recognize that that's a complete $60,000, which is its worth, gain. We also need to record the acquisition related expenses, which were legal fees of $5,000. So that will be a debit to legal fees, expenses, $5,000, or you could call it acquisition related expenses, $5,000. We also had a debit to share capital of $1,000, which is in relation to the share issue costs. So that's not an expense, that's a reduction against equity. And a credit to cash for $6,000 to balance the two. You can separate both these entries if you like. I'd probably prefer it. So a business combination doesn't always result in a goodwill residual, where the fair value's interest in the identifiable net assets exceeds the consideration transferred. A gain on bargain purchase arises, and that could occur because of errors in measuring the fair value of the assets and liabilities assumed and acquired, another standards reporting requirements, or superior negotiating skills at getting a good deal for the acquisition, or it could be, say, a fire sale where they just needed to sell the entity ASAP. It is considered a rare event, however, and usually you'd expect there to be goodwill occurring, which is the incentive for the other entity to engage in the business combination. Per AASB 3, paragraph 36, it says that in the event of a gain on bargain purchase, the acquirer is required to reassess that it has correctly identified all the assets acquired and liabilities assumed, and that they're measured at fair value correctly, and the consideration as well has been measured as at fair value. And if after doing these checks a bargain purchase remains, it's recognised as immediately as a gain in profit or loss. It doesn't go to other comprehensive income, it goes straight to profit and loss. And there's an example on 12.3, which is page 590 of your text, which goes through this event as well. Often the acquirer invests in shares of the acquiree rather than acquiring the net assets we looked at earlier, and the accounting for this depends on the acquirer-acquiree relationship. When this occurs, AASB 9 financial instruments applies unless the acquiree is a subsidiary, which we look at in topics 3, 4, 5 and 6, associate or joint venture, which we look at in topic 7, or a joint arrangement, which we don't cover in this subject. AASB 9 requires the investment to be accounted for at fair value of the consideration, and the accounting treatment is quite simple. It's just a debit to the investment in the acquiree and a credit to cash or whatever the consideration is. So AASB 9 financial instruments does come up a few times within some of the topics of ACC322, but it's not a focus of this subject. And there's an example on 12.4 of the textbook, page 595, if you wanted to look at that for further information. So at the initial recognition, AASB 9 requires that the acquirer make an irrevocable choice regarding where to record subsequent movements in the fair value. Say in future reporting periods the fair value would change, how do we record that change? And once we make this decision, we can't decide to change the way we account for it at a later date. So the first option is in profit or loss, where the subsequent movements in the fair value are accounted for through the profit and loss, and transaction costs are expensed, or through other comprehensive income, where the subsequent movements in the fair value are accounted for through OCI, and transaction costs are included in the measurement of the costs of the investment. I don't know how much this will come up with what we're doing, but this is just some background as to what's going on when shares are acquired. So the majority, if not all, the tutorial questions you get in this subject will be from the acquirer's perspective and preparing the accounts for the acquirer. We still need to understand what happens on the other side from the acquiree's perspective and how do they account for this business combination. So there's a few different events here. Firstly, where the acquiree does not liquidate, so when they just sell the certain assets and liabilities related to that to one type of business and they still continue with their other businesses, AASB 116 applies, and they recognise a gain on loss or loss on the sale of the operation. And there's figure 12.19 on page 597 to 598, which gives an example of when that occurs. The next event is when an acquiree liquidates, and when that happens, a liquidation account and a shareholders distribution account is created. They're clearing accounts, and that's what those accounts are used to effect the liquidation, and that's the most difficult type to prepare. Page 598 has an example of that as well. The third event is where an acquirer buys only shares in the acquiree, and no entries are required in the books of the acquiree. There's only a change in the share register. So I guess that's the easiest one to account for, because there's effectively no entries required. Subsequent to acquisition date, adjustments may be made to either goodwill, contingent liabilities, or the contingent consideration. With regards to goodwill, it needs to be checked on an ongoing basis, and it's subject to impairment testing. It's not allowed to be revalued or amortized. I mentioned this earlier, but contingent liabilities are initially recognized at fair value, and subsequent to the acquisition date, when they're measured, it can be the higher of either the best estimate of the expenditure required to settle the present obligation, such as where a liability was recognized in relation to a guarantee, or the amount initially recognized less cumulative amortization recognized in accordance with AASB 118. So that would be where a liability was, say, recognized in relation to a court case. And subsequent adjustments do not affect the goodwill calculation at acquisition date in these cases. And just a little bit more to discuss about contingent consideration, the subsequent accounting treatment. If it's equity, There's no remeasurement required, and any subsequent settlement is accounted for within the equity. However, if it's a liability, it's accounted for under either AASB 9 financial instruments or AASB 137 provisions and contingent liabilities and assets. So when the consideration is a financial liability, AASB 9 requires the changes in fair value to be done via the P&L, the Statement of Comprehensive Income, within the profit and loss section. If it's not a financial liability, you apply AASB 137. And also just to note that these subsequent adjustments do not affect the goodwill calculated as at acquisition date. Now looking at the last learning objective, D, prepare appropriate AASB 3 disclosures relevant to the establishment of a business combination. I combine this with learning objective C as this objective is covered over the one slide. Not too much to discuss here. And it says that there are extensive disclosure requirements in relation to a business combination, and figure 12.23 on page 605 of the text provides a sample of the disclosures using an actual business Pelican Limited. So there's the key disclosures are reporting the nature and the financial effects prior to releasing the general purpose financial reports, and the primary reasons for the business combination. So why did they make this acquisition? What method did they use of obtaining control of the acquiree? And a qualitative description of the factors that will make up goodwill. And the last point here says that the aim of these disclosures is to enable financial statement users to evaluate the nature and financial effects of the business combination.